SCORE offers free and confidential mentoring for small business owners, either to get into business or take your business to the next level. At this time, I'd like to introduce Kevin Morehouse from the SBA, who is actually going to be the moderator and running these. For those of you that are unaware, the SBA does a lot of these types of roundtables, so we're tapping Kevin as one of the lending specialists there. So I will turn it over to Kevin.
All right, great. So thank you, Louise. So again, I'm Kevin Morehouse. I'm with the Small Business Administration, and we have a great panel here to talk about lending tonight and talk about where you can go if you're looking for funding for your business. We have Rob Wheeler with the credit union. We have David Blow with the Vermont Economic Development Authority, Cindy Houston from Vermont Community Loan Fund, and Kyle Albee from North Star Leasing Company. I'm with the Small Business Administration. What does the Small Business Administration actually do? We do a number of different things. Advocacy is one of the big things. We're a voice for small business in the federal government. We provide resources to counseling. We partner with organizations like SCORE to help provide that counseling. There's a few other organizations as well that we partner with to do that. We help businesses obtain government contracts. And then probably the biggest thing that we do is we work in the finance world. So we help folks obtain loans. We don't actually do any of the direct lending. The lending is done from partners. So a lot of what we do is we have loan guarantee programs, and there's a whole variety of different programs that we offer that we partner with the banks and the alternative lenders and mission-focused lenders to enable small businesses to access the capital that they need for financing their business. So you could be a startup, you could be an existing business, it could be working capital, equipment, real estate, pretty much anything we're willing to help with. The key is you need to get a lender that's willing to lend to you. I can't bring the lender the deal. You need to get the lender to be willing to lend you the money, and then SBA can come in and provide assistance. So a couple things about lenders. You guys can correct me if I'm wrong afterwards, but so every lender and every loan officer is different. So what does that mean? That means you really need to find a lender that is willing to work with you and is going to be your partner. Again, as every lender is different, every lending institution is different. So you may go to one institution to obtain financing and they might turn you away, but you might go to another institution and they might actually be willing to fund your deal. So every institution has a different appetite for what they're willing to lend on, so you got to keep that in mind. One thing that I always recommend is find a lender to work with you that understands the industry that you're in. It's very key. Again, because everybody's business is different and you want to be partnered up with somebody who understands your business. And that's a key to success. The other thing about lenders, and this is from when I was a lender, I always hated when a borrower called me with a surprise. Lenders don't like surprises, so be upfront with them, let them know. If you're having, some sort of difficulty, you need to be upfront and let them know that. Lenders, what are they looking for? There's this thing called the 5 C's of credit. I'm sure folks have heard it. Lenders are looking for certain things, and this is really what they're looking at. So the 5 C's, the first one is capacity. So that's management skills, your background, your experience in what it is that you're doing. They look at cash flow. They want to make sure that you have the ability to repay the loan. Character, credit history, do you pay your bills on time? Do you have any violations with the law? Things that might be, that might not want them to lend to you. Contribution, they look to make sure that you have some sort of contribution in investment in your business so that they know that you're fully vested in that venture. And then collateral. The bank is willing to lend you the money, but they're always looking what they're going to get back should you not be able to repay the loan, so collateral. So it's the 5 C's, and that's really important. So when you go to look for financing, there's some things that you need to have. And you can certainly work with SCORE and their counselors. They'll be able to help you pull together a lot of these things. Their website has a lot of resources. SBA's website has a lot of resources. Reach out to the counselors because there's resources available to help you do things. So you need a business plan. That's the roadmap that talks about what your business is doing, what direction it's going in. You have to have it. Financial information, that'll be part of the business plan. So you'll need financial projections, income statements, balance sheets, cash flow projections. If you're currently in business, you'll need the historical numbers as well. You'll need to provide a personal financial statement. In all likelihood, you're going to need to guarantee the loan, and they want to look at what your personal assets are. And again, these are all things that SCORE can help you with. So tonight we're really here to talk about where do you find the money, right? So my advice always is look to yourself first. What do you have for assets that you might be able to get for money? Family, friends, and then maybe private investors, business partners that might bring some money to the table to help you fund your venture. And then look for loans to make up the difference. So there's banks, there's credit unions, there's alternative lenders, there's mission-focused lenders, there's leasing opportunities for certain things. There's revolving loan funds that are available out there. Your town may have a loan fund that might be willing to lend to you. There's a whole host of places to look to obtain the financing that you might need. So that brings me to, out on the table, there's this SBA resource guide. And in this resource guide, there's a whole list of banks, credit unions, alternative lenders, mission-focused lenders. They're all listed in here, all their contact information. In addition to resources to help you prepare for when you're going to the bank. So there's the SCORE contact information, which hopefully you already have because you're here. But there's other information in there that's very useful.
And that's Vermont specific.
And this is Vermont specific. Every state has their own guide, so it's Vermont specific. And then lastly, SBA. If you go to the SBA website, there's a tool called Link. And what it does is you enter in your basic information, and we have 2 of our Link lenders are here tonight. They get a notice saying that you're looking for financing. And they have an option to opt in, and if they opt in, they'll get additional information, and somebody will call you to talk about what it is that you're looking to do. It's basically a matchmaking tool to match you up to obtain the financing that you're looking for. There's a whole bunch of lenders and whatnot in the state of Vermont that are partnered up with SBA for that, so that's a potential tool as well. So with that, I don't want to take too much time talking about resources and things like that. Really, we want this to be kind of free-flowing, so what we're going to do is we're going to have Rob talk about financing that the credit union does, Dave talk about the financing that Vita does, Cindy talk about the financing Vermont Community Loan Fund does, and Kyle talking about the type of financing you could get from North Star. And then we'll open it up for questions. So,
thank you.
Rob?
I'm the commercial loan department manager for New England Federal Credit Union. I've been here for approximately 13 years and have a banking career in the commercial banking field of 25 years. So one of the things that I've seen in my banking history, and more specifically here, as it relates to applying for financing, are people that come through the door that want the institution to do their business plan, to do their financial information, to put their resume together, to do essentially everything for them. I can tell you that you probably won't find institutions that are willing to do that. A couple reasons why. One, if the institution is wrong in its projections or its help with you, you guys could come back and sue the institution for some wrongful numbers if you were harmed in some manner. Okay. Secondly, it really comes down to borrower preparedness. It's incumbent upon you and your businesses and the people that you work with to prepare information that is it's readable, it's in a good format, it makes sense, to convey the story of why an institution should lend money to you. You guys are applying for financing. You're not looking for somebody to really hold your hand, or some people may, but I can tell you that most institutions don't look upon that favorably. People are busy. And the other part of it is, if you don't have sort of your emotional capital involved in a project, i.e. your business, then the institution, the bank or credit union or Vita or North Star Leasing, they may not take you seriously. So you want to start off on your best foot, okay? Another piece too is, as you guys enter the financing world, is to understand where you sit and what avenue is more appropriate for you guys. I mean, if you are a seasoned business with a proven track record, then your financing may be more acceptable from what we call the conventional side, which is the bank or credit union side. You don't need necessarily assistance from a Vermont Economic Development Authority or Vermont Community Loan Fund or an SBA or a North Star. You can do the financing through somebody like myself. And it's real traditional. It's what he talked about in terms of the 5 C's. You just heard about those. One other piece I would add to that 5 C's are the conditions to the lending. It may be one thing for you to be outfitted with a $100,000 loan to buy a piece of manufacturing equipment and you have to put 20% down. But if the bank or credit union requires you to repay that loan in 2 or 3 years, that could be a killer for your business. So you don't want to constrain your business's cash flow to make the piece of financing to the point where it's I use the word, no pun intended, a liability rather than an asset. You want to make sure it fits. It's the right fit for your business, okay? Going back on the conventional side, the things that you guys to think about, and something Kevin touched upon, is the personal assets. A lot of people do not understand that commercial financing or business financing can be done through personal assets. I can't tell you how many times people have come to the door, they start talking to me about a business acquisition or some acquisition for a piece of equipment, and they say, gee, I don't have the 20 or 25% down payment that you require. Gee, can I get something else? Well, when you come prepared with the financial information and provided it's accurate, we look for little treasures in your balance sheet. And if we can find a situation where you own an apartment building that's debt-free, or a camp up in the Northeast Kingdom that you hunt at or recreate at, those are viable collateral sources for an institution and can be lent against, to the point where you may not even need to go through the process of putting together a business plan. You kind of circumvent the process. You get a mortgage or some type of loan against the asset, the camp or the apartment building. You get the money that you want, and then you can turn around, lend it to your business or inject it into your business however you see fit. So that's the part of the conventional side that you guys should be aware of. It's important to be aware of those things because other alternatives, he mentioned family loans, other people that do equity loans, their financing pieces may be significantly more costly to you guys. Costly in the form of interest rate. You could literally be looking at situations where you're financing, you'll get the money, back to the conditions piece again, you'll get the money and the condition of repayment might be right, but the condition of interest rate may not be appropriate. You could be saddled with a 14% interest rate. You don't want that. That's most likely not going to be right for your business. That may not be right for you. And the family members could do this very same thing. So if you go the conventional route, the real estate assets, even vehicles, even equipment that you may own, the institutions have the ability to lend against those assets. And if they can qualify and do qualify, you're looking at interest rates that could literally be as low as 4 or 5% for 5, 6, 7, 8, even 9, 10 years. So something to consider. So back to the conventional side, that's my job. My job is to, on a day in and day out basis, to interview people and talk about their businesses and start leading them down and understanding what attributes in terms of the 5 C's with the 6 C's conditions that they can satisfy. If there are instances where we see a little bit of a hiccup or a blemish, so for example, a late payment on a credit card, a damaged credit score, collateral is just about sufficient but not sufficient enough, those kind of things. We look at those pieces and say, or if you're a startup business, you don't have that proven track record, we look for other avenues, other resources to get you guys the financing. So back to Kevin's comment about partnering with the right institution, you want to make sure that the institution that you're speaking with not only is thinking about doing a loan or piece of financing with you under their roof, but also has the ability to say, geez, you know what, this financing doesn't work for us right here, but let me tell you, go talk to David Blow at Vermont Economic Development Authority. They have the ability to lend monies with some more relaxed conditions and criteria, much like the SBA. Well, you guys are one and the same, essentially, at times. Never mind. Yep. But and you'll find yeah, you guys, you'll find that back to interviewing your lender, like Kevin had mentioned, you'll find that they may be able to lend monies to you guys on a more relaxed basis, lower down payments, maybe a slightly higher interest rate, but it eventually could get you the money that you're looking for to bring your business or yourself to that next level. So it's important to look at the conventional avenues, and then if those can't happen, also interview or make sure that the lender has connections or connection points to alternative lending, right down to North Star Leasing and the Vermont Community Loan Fund. So that's just a little bit of the overview of what I do. I mean, the financing types, I think you'd ask me to touch upon that. I mean, we're really traditional lender here. We really like real estate. We have, 90,000 members, and we lend in the territory of 6 counties within Vermont. Okay, so we have a limited presence. There are 90,000 members. Most of them have mortgages in some form with us, home equity lines of credits. As to the business side, we focus on line of credit financing for working capital needs. That's a real traditional piece of financing. We also do real estate lending, and those are really the main attributes. And of course, equipment. I mean, I can't tell you how many high tolerance lathe machines that we finance for people in the manufacturing business. They're high priced, they cost money, they may be more expensive than leasing it from the manufacturer, and we finance them. We do a fair amount of that, and so it's equipment, line of credit, real estate type financing, and then vehicles. You know, everybody needs a work truck or what have you, and we do that as well. So those are the conventional pieces. I'll hand it over to David to talk about sort of the complementary services that he offers.
All right. I'm David Blow with Vermont Economic Development Authority, or VEDA. We are a statewide economic development finance lender. We were actually created by the state legislature back in 1974. We were created as a mission-based lender to contribute to the creation and retention of quality jobs in Vermont by providing loans and other financial support to eligible and qualified Vermont industrial, commercial, and agricultural enterprises. In the past 42 years, we've lent over $2.16 billion to over 7,500 businesses and farms. And that's quite a feat because typically we're in a second position. We always pretty much team up with lenders like New England Federal Credit Union and other banks. So it's it's amazing. We've created, I think the money that we've lent have created over 10,000 jobs in the state of Vermont. So again, we're a mission-based lender. Some of the things that Rob touched on about conventional financing and where we come into play. We are a secondary lender. What that means is we team up with the banks, the credit unions. We are in a subordinate position. Rob, as the first lender, would have a first mortgage or a first lien on business assets. We come in at a subordinated position. We have a second mortgage or a second lien. We actually have fairly decent rates when it comes to that. We are a nonprofit. We actually borrow money. We are backed by the full faith and credit of the state of Vermont for some of our loan programs. So we're able to actually give you guys really great interest rates, even in a secondary position. Some of the reasons why you would come to us or Rob would come to us, you go into a deal, you're looking to buy a piece of real estate, but you really don't have the 20 or 25% down that you would need to put in doing conventional. Some of our programs allow you to put as little as 10%. On the farm side, there are times where you could actually do 100% financing depending on the type of property that you're looking to do, and there's a whole slew of other things that the agricultural side does that I don't quite understand. We have several loan programs. We have probably 20-plus loan programs. Some of them are very specific to heating in the capital of Vermont, Montpelier capital. We have other ones that are specific to energy. We have our agricultural lending. From what I heard earlier, I want to touch on 3 of our programs. They're all very similar. Again, we subordinate to the credit unions or the banks. They can be as little as 10% down. What happens is the bank or the credit union would look at the project, and when we say project, it could be the actual real estate purchase, but maybe you need some improvements that you need to put on the property as well. Or maybe there are some soft costs, there's attorney fees or engineering costs because it's construction. We can add those to the project. Rob would do a 50% first mortgage. We would come in and do up to 40% second mortgage. You guys would be required to put 10% down. That 10% equity we always like to see it coming from your own pockets, but it can also come from family members. It can come from seller financing, and there's other rules for that. Our bread and butter loan program is our small business loan program, not to be confused with the SBA. It's a loan program where our portion can go up to $350,000. It goes well with a lot of the deals that are in Vermont, because if it's about $1 million project and under, it works out well. Again, we do 40% of the project. It's priced at 4.25% fixed for 5 years, and then it floats after that. Depending on if it's real estate, we can match the term up to 20 years for amortization. If it's equipment, it's usually going to be about 7 years. That is our biggest loan program utilized. We have many of those in our portfolio. What I like to say is that we have a parent program and a child program. That would be our child program. The parent program is similar in nature, but we go up to $1.5 million on our portion, so we can look at much larger projects. And that's called the direct loan program. Just so you know, there is a stack of called program summaries out there for those of you who have not gotten them already, along with my business card. It will describe and talk about the individual programs. Our website also is very comprehensive, so make sure you take a gander at that. With the direct loan program, we go up to $1.5 million, but there are a couple of industries that we're not able to lend to in that one. Service and retail. When the program was created back in 1974, retail jobs and service-oriented jobs weren't actually very well paid at that time. So we are kind of limited to what we can do under that. It was really geared towards manufacturing. Under the small business loan program that I spoke about, we can do pretty much anything under there. Where we come in and when we can't do a retail or service on the direct loan program, we have the SBA 504 program. That's where we, as a certified development company, we work with the credit union and the banks, and we provide a secondary loan, again, in the subordinate position, utilizing an SBA loan product. On that piece, our portion actually can go up to $5 million on a standard 504 project and up to $5.5 million for manufacturing and energy efficient type projects. Again, the same premise. It's, we come in second position, bank or credit union does 50%, we do 40%, you guys come up with 10%. The banks and credit unions a lot of times pull us in many times when there may be a collateral issue, collateral shortfall. On the 504 program, there are certain things that we can do when there's a collateral shortfall. A lot of times, though, we're pulled in because of the down payment. You mentioned about a 25% down payment, and a lot of times, it's hard for you guys as entrepreneurs to come up with that, and it makes more sense for you to keep more money in your pocket if you can handle the debt load. Projects that we look at, we have no problem with startups. We have no problem with hospitality. The problem is finding another lender to work with us, to partner with us. So we pretty much look at nonprofit, for-profit. We help regional development companies. Unless it's illegal, we can pretty much lend to you guys. The other thing that I wanted to stress is that we all work together fairly closely. There's going to be projects where the credit union is involved, we're involved, Vermont Community Loan Fund is involved, even maybe the SBA or the USDA. So what we do is we look at a project and we're going to look to see how we can get this done for you. We're going to find a way for you. It may not be with us. You may come to me and say, hey, what can you do here? I may not be able to help you out, but I can refer you to Cindy, or I can refer you to the USDA, or maybe Rob can do it all by himself. But just know that when you come to us, we're not here to say no. We're here to see how we can get this done for you. and we'll try to figure out the best way to do that.
Okay, Cindy from the Vermont Community Loan Fund. How many folks here are from Chittenden County? Is that the majority of folks? Okay, all right. We are an alternative lender, a revolving loan fund. Money comes into the organization by way of investments and donations. We get foundation support, and then we take that money and we lend it out to borrowers. We have 3 different programs: a housing and community facilities, a child care program, and also a business program. When it's a 5-year term generally, because that's the term that we get from our investors. So the money flows in by way of investments, we lend it out, the borrowers pay back, we pay back our investors. So normally our loans are 5 years and they mature, but then we just renew them for another 5 years, assuming we have all the information we need to do that. It's a performing loan. So that's the way we work. Our interest rate is 7%. We fund up to $350,000. We only fund businesses, so we don't do any residential mortgages or any vehicles or anything like that. What I tell folks is that if you have a banking relationship, that you have a relationship now, you should stay with that bank. A bank is a full service lender. We don't want to take business away from banks. That's not our role. We will, if you don't need to be denied from a bank to come to us, but we're not in the market for taking away business. A bank is a full service. You need the deposits, you need the checking, you need the payroll, you need the investment pieces, maybe you need the personal as well. So it's a one-stop shop. We only do loans. We have investment vehicles so that if you wanted to make an individual investment or if you wanted a CD or something, we could certainly help you with that. But that's the investment side of the house and not the business lending. My role as a microloan and grant portfolio manager is varied. It seems to be changing all the time. So I do a lot of reporting to the federal government and also to SBA. We have quite a lot of funding sources. That's why I asked what part of the state you're from. We only fund statewide. Tomorrow I'm going to Rutland. Yesterday I was in Virgins. I do everything from the reporting part to working with delinquencies to workouts, extending loans, working with becoming loan ready. So I'm from soup to nuts. It's a small organization. We wear many hats. And I think it's really good because as someone who's worked in a role of workout situation, you really have a lot to share with that startup. You know, the importance of how to make sure that you're able to cash flow and when to come to us before you get into trouble. So, and the importance of financial information as and all the other tools you have in your toolbox. It's really important to do the financials. A lot of folks don't do them. It's really hard because as an entrepreneur, you're wearing a lot of hats. Not only are you making the widgets or providing the service, but you're also doing the marketing and the sales and the collections and you're distributing and you're doing everything. And there's not a lot of time left over for the backroom administrative stuff and who wants to do, their income statement or balance sheet. The best thing you can do for your business is to really pay attention to that, because you want to have a relationship with a lender before you need a loan. And the best way to do that is to have your balance sheet and your income statements and your projections and your roadmap. I mean, your business plan is your roadmap. Where are you going to go? How are you going to get from here to there? And that's the language that we speak. The lenders talk numbers. So when we ask for something, it's not that we're trying to make your life difficult or putting you through the ropes or anything. All we want, that's our language. That's how we know whether or not you can repay us, because when you repay us, I'm able to pay back my investors. We've never lost a penny of our investors' money. So we work really closely with our borrowers, and sometimes they resist because it's like, I just want to make my widgets. I just want to provide my service. I don't have time for all this tax returns and, all this stuff. But we want to see that because we want to see the trends. We want to see, it's another pair of eyes to say, how are you doing? What are your needs? Are you going to need interest-only period? Are you going to need more equipment this year? Let's talk about that before, you need it. So you're not scrambling and then you're frustrated with us because we can't turn around overnight. It usually takes a couple of months to get a loan. It's a process. And it's not, if it was loan ready, if it came and we had everything we needed, we could probably underwrite that in a week. And then we have to bring it to committee. And sometimes that's on a cycle where we only meet monthly. Or sometimes it's something that we can bring in-house if it's less than $75,000, but then we only meet weekly. So, but it's still a process and it's a timing issue. So the more complete your package is, the faster that we can turn that around for you. But we have a queue. I mean, we're not going to crash the schedule because now your loan is appeared. No, I mean, you get in line with everybody else. But if your information isn't complete, we park it, we wait for your information, we get another loan, we start working on that, and then if that's going, we want to see that through. So in many times, working on several deals at a time. So the best thing you can do is be prepared with the complete package when you go to your lender. And to have a relationship with a lender before you need it. I think having a package together with your 3 years tax returns, business and personal, having an updated personal financial statement, and having all your appraisal for your commercial and for your residential, having all those things at the ready, and then it's in a file, and then when you need it, it's right there. You don't have to go scrambling for it. If you can put it in a PDF file or a soft copy, all the better, because then you can just email it to us or just give us a disc or something. We work very closely. We have a very good relationship with all the lenders. We get a lot of our deals from banks. We're not a traditional lender, so, I mean, how many people have even heard of the Vermont Community Loan Fund? I mean, you don't hear about that, right? Because we're an alternative lender, we're not mainstream. We get our deal flow, our businesses, usually from other lenders, because they're looking for a niche lender. They're doing the building, but they want someone to do the equipment. Or they're, like Vita, we work really closely with Vita on partnering on deals. Like they'll do 250, we'll do 250, or we'll do pro rata, if they do 75, we'll do 25, depending, just to get the deal done. Because there's a loan ratio we have to comply with our policies. So we work really well together in Vermont with other lenders. We refer to each other. We do take people, startups. We do sophisticated businesses. It could be $1 million business, and they might just need a piece of equipment for $250. What we're really looking for in my startups, you need to be coachable. Please admit that you don't know. And you just need to say, I need help, and we can give you the help. But if there's nothing to work with, it's really hard for me to do my job if I don't get the information I need to help. So we're not trying to make it difficult. We're not trying to be obstructionist, or it's not that we don't want you to get the loan, but we can't. We have to talk our language, which is the numbers, which is the financials or the projections. And you say, okay, my sales are going to be, my projections, I'm going to make $100,000 this year. Okay, well, what's the backup for those sales? Can you show me who your clients are, what your orders are? Do you have purchase orders? Do you have contracts? Show me what all goes behind that income. And then show me about your expenses. Don't take, I think my insurance is going to be $20,000 and divide that by 12. No, because it hits on a quarterly basis, and your taxes are going to hit on a quarterly basis. So have your cash flow reflect your actual cash flow so you can see where you're going to dip, and then when you're going to have a surplus. So you know when you're going to have those moments where you're just going to struggle, and then we can maybe work with you on an interest-only period or a seasonal payment schedule so that you're not struggling to make a principal and interest payment at that time. For collateral, usually it's the life of the collateral that one of the things that we ask for is not just, we want to see that it can cash flow, but we don't strictly make collateral loans. We want to be able to it's everything. It's the character, it's your credit score, it's everything. Do you have the capacity? Do you have the business acumen to actually be an entrepreneur and to be successful? Because we don't want to put you in debt. We don't want to revisit this as a delinquency or as a default or foreclosure or anything like that. We're social mission lender. We don't want to do that. We'll work with you as much as possible. So the first method of repayment is from the sales of the product or the services. The second method of repayment is from the sale of the assets that you've pledged against the loan. Maybe it's that equipment you purchased, so you sell that and then you pay down the loan. Tertiary, the third method of repayment is your personal guarantee. And that's why we have you do the personal financial statement. So we can see, how are you managing your personal credit? What do you have for net worth? Do you have assets that you can sell to pay off that loan? So those are the reasons why we ask for those things. It's not that we want to get all up in your business to that extent. I mean, we do. We're in this together because we want you to succeed. But it's not that we're asking for this arbitrarily. We're asking it because we want you to be able to repay this and be better off, not losing your shirt or not losing everything, having assets to sell. So that's my little piece. If you have any questions, I'll just turn it right on over.
Okay, hi, I'm Kyle Albee with North Star Leasing Company. I work in the underwriting side, and I've been there for about 20 years. And North Star Leasing, are any of you folks familiar with our business? One or two? Okay, so that's not that unusual. We've been around since 1979, financing business equipment all across the country. When they hear the word leasing, and they think that we have a parking lot full of equipment out back. We have no equipment out back. We just have a parking lot. So what we really have is a drawer full of checks that we fund equipment from. So we work with customers that are just starting out in business, folks that have been in business for a long time. Our average transaction is around $18,000 for a customer that's looking for a piece of equipment. We'll go down to $1,000 if that helps them out. And our upper limit is probably somewhere in the six figures. We're a non-bank lender. When you hear a lease, it's with a dollar purchase option. It's not like a car lease that sometimes may never have an end, or you get to the end of the lease and you have to buy it all over again. So really, if we set you up on a 3-year term, at the end of the 3 years, you're going to pay an extra dollar, which is sort of a formality than anything, but it's what makes it a lease, and then you loan the equipment at the end. We really don't expect to ever see the equipment come back to us. We're a little bit different. It's interesting to hear the different parties here because everybody does something a little bit different. We're probably very, very much more different than the other three here. Our application process is quite simple. It's an application that generally takes about 3 minutes to fill out. We're oftentimes not looking for financial statements. Once in a while, bank statements. Not often for the dollar amounts that we're looking at a financial plan. So we're taking a look at the application, we're pulling a credit score. If you are a new business, we'll want to probably speak with you on the phone and see what your plan is. Oftentimes, new business owners are still working at their jobs, and we really like that because there's a constant source of income, and maybe they're an engineer and they've been kind of dabbling on the side, or maybe somebody in the family is doing some embroidery and they want to turn this into a business, and that's just great because they still have this regular income source that's coming in. The leases go between 1 to 5 years. We try to get back to our customers within 4 hours as a turnaround time. Why would somebody come to North Star maybe than a bank? All of you are going to need a bank. There's no question about that. We don't have deposit accounts. We don't really play in the same pond as a bank. But every business owner has a maximum line of credit with any bank, and there's good reasons why you want to put a piece of equipment on a lease program. One, if you're with a bank, you have a maximum line of credit, and we sometimes look at that as a parachute. And you may need that for things such as working capital, for inventory, payroll. And if you're using your line of credit up for equipment purchases, you don't have that available for other things when you need it. We don't report on your credit bureau each month. The only place that we show up is just an inquiry on the credit bureau. There may be different tax treatments with a lease than a loan, but we're not CPAs. We don't pretend to be, so you'd want to ask your tax accountant about that. Oftentimes, we see people that are starting in business, and they're using their credit cards to buy equipment. And they're thinking, well, I've got 0% or I've got a low interest rate. Well, they go out and buy a bunch of equipment, and next thing you know, they've got their credit cards really heavy. So when they go see somebody like Rob and they need something, he's pulling their bureau and saying, your credit score has sunk because you have 3% available on your credit cards, and that becomes a problem. So we encourage folks not to use credit cards for longer term purchases. They really ought to be used for other things. You need tires on your car or something like that, or you're going on a trip. But we don't recommend people putting $8,000, $10,000, $15,000 worth of equipment on a credit card, because also if they're one day late, that 0% can turn into something a whole lot more. We're much more flexible, I think, in some cases than other sources out there as far as the equipment that we will finance. Obviously we'll look at new equipment, we'll look at used equipment, we'll look at private sales, we'll look at equipment that's older sometimes than other lenders or financing companies feel comfortable financing. Our test is this equipment going to make you money, or is it going to save you money? In some cases, well, not in all cases, when we're looking at a new business, if you were, say, for example, working over at the tire center last month, and you'd been there for 10 years, but you always had this dream of opening a restaurant, as many people have, and they come to us and say, geez, we'd like to, finance $20,000 of restaurant equipment. We're probably not going to be that interested. We really like to see people that have some experience in the field that they're going into. Again, they may have dabbled in the side. It could have been something that they were doing. They could have been an executive chef downtown, or they've worked in restaurants their whole life, and now they slowly want to get into and own their own business. And that's what we see oftentimes. It could have been somebody up in the Northeast Kingdom that's been logging their whole life, and now they want to purchase a skidder. It could be somebody, like I mentioned, that has an embroidery machine. Oftentimes it's businesses that need to expand, because again, will that piece of equipment save me money or make me money? It can be a restaurant that's looking at a new pizza oven, and if they get the new pizza oven, well, the old one was electric and it's running up their electric bill, or if we can get this new gas oven, then we can pump out X number of additional pizzas an hour. So when you folks can articulate that to us, it really means a lot on our end. You can articulate your experience, why you're getting into the business. Like Cindy says, the passion comes through. It's the character test. Can the person walk and chew gum at the same time? Many times, not everybody's credit is perfect. There's bumps in there. The main thing to us is, please, whether you're speaking to us or somebody else, own up to your problems in your credit bureau. I've never seen so much amnesia when I ask somebody about, it could be a bankruptcy, it could be a federal tax lien, it could be something pretty big, and you know it's big, and you ask them about that, and that was a long time ago. Well, it really wasn't. And if it was a bankruptcy or something like that, that was a traumatic time in your life. And that says to me, if you can't come clean and say what this was about, then we don't feel as though we're dealing with an upfront person. The best thing somebody can say is, and I'm not putting words in anybody's mouth, but I made a big mistake, and this is why, and this is what happened, and this is how I've learned from it. Because let's face it, we all fall down in life. It's how we get back up. And those are the kinds of things that can make a big difference to us. We have had situations where people have come to us, and we're not as beholden to credit score. Situations all over the country. People have been hurt. The 2008 layoff crushed people. They took a lot of good people and put them out of work. We've had veterans come back from Afghanistan losing limbs. We've had people that have had children that have been killed in car crashes and said, geez, I just lost it for 3 years and I really couldn't work. But they've put themselves back together. Their credit score doesn't fully reflect it, but we will believe in them if it makes sense, and we'll finance them a piece of equipment. And by golly, if they're hardworking, they'll come back to us. And that's how we've built our business. We're not about making a one-off deal, although we do plenty of those. We're really about building a long-term relationship. We start with many customers that could have started with a simple pressure washer that might have been $2,400. And yeah, they could have put that on their credit card, but they may have still been smart not to. And the next, 2 years later, they're coming by to us and they're buying a trailer. And now they need a truck, and we're financing that to them. And guess what? That truck was an older truck, and now they're using it, and the truck engine blew. And they're out in East Podunk, and they call us up. And we say, I tell you what, bring it in there and get the thing fixed, and send us the invoice, and we'll refinance this thing, and we'll do those types of things. Or maybe they have funky situations where one of you may be in business and you need $9,000, $10,000, $15,000 for something. Maybe it's software, maybe it's just some improvements in your building, and you need some money. Well, what do you have for equipment that you own? Well, I have this piece of manufacturing equipment that I paid off. I have a truck I paid off. So we try to get creative where we can to help you out. Maybe we'll take that piece of equipment in as collateral and fund it back out to you. We'll finance things that other people aren't really that interested in. Maybe you're in this is sugaring season. There's not that many companies that are interested in financing equipment that sits in the woods all year long. But we know that if that's not sitting in the woods, you're not making any money off of it. So we do things that are a little bit different. We've been doing it this way since 1979. I don't recommend everybody do it. We try to fish in our own pond and stick to our knitting. And if you come to us and say, I need $100,000 to buy a building or a build out, then I'd say we're just not the people for you to help you with that. We oftentimes try to, like Cindy or some of the other folks, realign people. They may come to us with champagne taste on a beer budget. They may be looking for something that's $25,000. And you know what, at the end of the day, they probably do better with something that's 13 because they're trying to start out, and we're trying to make sure at the end of the day that we set them up for success. We have an old saying at North Star Leasing, succeed by helping others succeed. And that's worked well for us, and I look forward to your questions.
So at this time, I'd like to throw it out to all of you. We've got a lot of knowledge up here, so anybody have any questions?
I'm interested in finding out how to, you said you probably could come with, if somebody had 10% to give down for a property or something, they want a house. And I thought about the business aspect of putting a nursing home on the other end to pay for, put some people in there that are able to take care of themselves somewhat, but they don't need nursing care. How do I go and where do I, because it's a little bit, big thing for me to have something in my mind like that and don't know how to do this.
So from a lending point of view?
Yeah.
Or, okay.
So I have a couple of thoughts about that. One, we have done adult day centers before. We have funded community facilities where there's actually residents staying there and have providers. I think the most important thing is you have to have a concept. You have to have an idea, and that's where your business plan comes in. So you have this is my idea, and you write that down, and you say, well, this is how many square feet, or how many bedrooms, or whether it's just going to be a daytime, or whether it's going to be, just weekend care, or however many people, how many providers you want. And then you have to run the number, what the space, how much space do you need? And then you need to run the numbers and think about what all goes into that, whether it's the salaries, is there workers' comp, there's insurance. And that's something that the SBDC counselors can help you with, or SCORE can help you with, fleshing that out and coming up with an idea, a business plan.
Yeah, that's what I mean.
So, and whether you own that house or whether you rent the house or however you manage that really depends. And if you don't want to do the whole thing, maybe you have a partner. So maybe you provide the services and deal with the staff and they do the financing of it. Maybe you have a person that does the food part of it or the activities piece. So it really depends on what you want to do with this business. You just have to think about it and write it down and dream about it.
I've been thinking about these things, and I'm trying to, but I don't know where to go or what to
Yes.
get.
So as she said, there are partners, the SBA funds a lot of resource partners, SCORE being one of them, and that's what we do. We help people navigate through all those questions so that you can then bring yourself to one of the lenders, because you've heard them all say. Any other questions for these lenders?
I'm sort of wrestling. My business runs out of the generator here in Burlington, which is a maker space, and a lot of companies are growing there right now, which is really great. My company, I do some furniture design, and sort of it was on the side, and all of a sudden Room and Board wants to pick up a couple pieces of my furniture. Well, they want a few thousand pieces of furniture by December this year. Good problem to have, but we're sort of wrestling with, and I think a lot of people in general are wrestling with, a line of credit versus a loan. I think I don't know how to use each wisely. I don't know if a lot of people ask the same question of me, so I don't know if you guys have any advice.
Who would like to
So you actually have another option there too. It's a contract receivable that can be extended financing through the SBA that you might want to look at. Is it one contract that you're looking to finance, or is it with a bunch of other people that are looking to buy your products, sir?
Well, we would probably sell directly on our own lines of furniture. Room and Board wants exclusives on stuff that I've already done.
Okay.
I'll give it to them, that's fine. They can sell thousands of units per year like I can't.
Yeah, I understand.
So
You have a situation where you're sort of the snake that swallowed the pig. That all that does is that creates working capital demands.
I'm just waiting for a PO so I can really go out and do something, but that's.
Yeah, and it's not an uncommon problem because a lot of people get successful. Then next, somebody like if you're selling mustard, for example, Hannaford comes to you and says, "We'd like 10,000 of these units tomorrow." You have a similar situation. The real challenge is whether you get a term loan, which is a principal and interest loan, or do you get a line of credit to finance the situation. I would look at the line of credit piece because the financing, the repayment of that is interest only on a monthly basis, okay? If the lender, whomever you approach, is smart, they're gonna, if you have a specific contract in place with that particular company, they're gonna take an assignment not only of the receivable that's created as you develop and sell your inventory, your furniture inventory, but they're also gonna make sure they take an assignment of the contract that's with the end buyer with you, okay? And that can be done, as I said, financed through an SBA piece. There's a little bit more risk involved. But on that word risk is you have the situation where a lot of people don't understand in the new business world is that growth kills. And if you don't have the alternative types of, not even financing, it's alternative monies, it's cash in your pocket, equity, or even investors, which again, that's more of a loan as well. But you have to have the hard cash going into the project. That's going to help you get past the swallowing of the pig portion of it, and some of it may be the financing itself from a bank, credit union, or what have you. So my recommendation would be to look at how many units you think you're going to manufacture, how quickly you need to do that, what kind of capital challenges are involved in that. Are you going to have to hire 2 or 3 more people to work and put assembly and think about that stuff? You've got insurances there. That's a miniature business plan for yourself to understand how you're going to get past the situation. And it's a good bad situation, but it can also be a bad good situation. And that's what you're looking to do. But focus on those avenues, those pieces, and that will identify the amount that you need to get past the hurdle, and how much of that of your own money do you have to put into the project or into the manufacturing process, and then the net result of that is the loan amount. Here's why it makes sense to put your own money into the projects. I mean, a lot of people will think, oh, geez, that's my money, I need it for working capital or paying my employees and things. Your money has the cheapest interest rate. It doesn't have one, it's 0. So that's important. So it's a cheap source of a cheap funding source for you guys. If you don't have money, I will tell you, institutions will look at that more on the conventional side, which is where I live. They're going to think, okay, boy, that's a little bit risky. What are my risk tolerances here? I don't know if they're going to be acceptable. I don't, without knowing you and your business, you may get immediately put into a situation or an arena where I say, geez, you know what, we can't help you. That's outside our risk tolerances, but geez, go talk to Kevin and to David or to Sid. I think they can really help you. So.
Yeah, I mean, we've bootstrapped the business from the ground up, and now it's turning into a situation where we have to grow.
Did you want to add more?
Yeah, the first thing I would add is if this is a one-shot deal or if this is going to be repeating business, because that can make a big difference on how you approach solving the problem.
Yeah.
And I wanted to ask the panel, does anyone up there factor accounts receivable or purchase orders? Do any of the
Well,
commercial
for our
banks?
lines of credit, we have a borrowing base generally, not always, but it's against receivables and inventory. What I would caution you is have a diversified revenue stream and not to put all your eggs in one basket. It's very enticing to have these big clients, but the bigger they are, the harder it is to recover from. I had one borrower, a glass cutter, and they had a special order, and they dropped the order after the glass was etched. and they were writing that off the books for several years. So just be careful, it's very enticing, but just mitigate that loss as much as you can. Maybe the vendor or maybe the buyer would be willing to give you a down payment for the materials. So then you're only looking for
Yeah,
the
our
payroll.
core business is design, development, prototyping, all that kind of stuff, and CAD and doing that kind of work for people. Now this came up, so it's
Yeah.
like, heck, us.
And maybe not now, maybe the answer is no, I mean, not no, but not now.
Yeah.
So maybe, maybe it's all about timing.
Okay, so you had a question?
Well, just to, so could he go to you in advance thinking that he is going to need this big, if he gets this big purchase order, can he have funding set up in advance and then will it have wasted your time? Would you even talk to him without having the purchase order?
Yes, we would. And
You would.
what can be done in setup is what we call an advised line of credit. So the advised piece means that the institution, bank or credit union, holds back the release of monies until such time as this gentleman comes and says, geez, I've got this purchase order for 10,000 units. You've approved a line of credit for me for $50,000 with conditions that I come to you with a viable purchase order with maybe some monies being contributed from the buyer to lessen the financial load to you. So there is that possibility.
And it's not just the lender's time you're wasting, it's the entrepreneur. This is a big time suck for him. If he's spending all his time trying to get bank ready and try to meet this needs, he's not spending time making his product or managing his business. So,
That's the problem.
yeah, you've got a lot going on.
Is it possible for us to see our business credit score?
Credit Karma, your business credit score.
Business credit.
Is there a site similar to that for businesses?
So it's like a Dun & Bradstreet.
It's not easy.
I thought Dun & Bradstreet was different, but
They're comparable. I will tell you, we don't use them. And the reason for that, a lot of the data that's put into the credit scores they call you up as a business owner and say, tell me about your revenues last year. You can make up anything you want. And tell me about your average payables and how quickly do you pay the payment. It's all this really, not personal data, but it's not necessarily objective data. It's could be falsified, fictitious. So, yeah. So we don't use it. I don't know. Do you guys use it at all?
We have the SBA programs.
So SBA programs, they run all the loans through like a credit scoring type process.
It's a pre-screen for
It's a
credit.
pre-screen for credit, but it pulls from your personal credit history. It will pull, if you have a DUNS number, it'll pull information on the industry. If there is anything out there on your business, and somebody reported that you've received credit and hadn't paid it or whatnot, it'll pull that. But SBA's system is set up, we basically have scored our entire portfolio. So millions of loans have been run through this model. So it's kind of an internal scoring that we look at, but it's not something that the general public has access to. I work for the SBA and I don't even have access to it. So,
And you wouldn't understand it.
and I wouldn't understand it anyway. It's a lot of algorithms that go into it. It basically spits out a number, and if you're above a certain range,
120. 120 is the threshold, and I have 90 loans in my portfolio, and just the heck of it, I ran some, all of them were better than the 120. 120 is a really low threshold. Now this is for the community advantage for the SBA program. I don't know about the Dun & Bradstreet and what all that doesn't do anything. It doesn't do anything
There's
for
also
me.
Experian business credit that you
Yeah.
can pull similar stuff, but it's, again, like Rob said, it's,
It's what you put in, garbage in,
Yeah.
garbage out.
yeah.
It's the
I mean,
proprietor.
it will look at certain things, like if you have a bankruptcy or for the business, or if there's liens against the business, they will pull that, and that will affect the score, but again, I don't want to say it's arbitrary, but it's not as accurate as a personal credit score.
You had a question?
I guess my question for Rob, have you heard of the term allonge?
Yeah, it's a modification, another word for modification, correct?
Are banks still doing that today for special customers?
I don't think the word special is involved. I think they'll do it for any customer.
Anybody that
Yeah,
would
so-
ask for it?
Yeah, institutions are willing to consider any modification that you bring to them. One that we receive a lot is people who go through this, make a substantial principal payment on their term loan, for example. They come back to us and say, gee, boy, I've been making, I made this large payment. my monthly payment is $10,000, but I just made a payment that's more than half of what's outstanding. Can we modify or execute a melange to make the payment where it's now $2,000 a month for the remaining term? Yeah, sure, we'll do that.
Okay.
But yeah, so you should ask the institution.
I've gotten 4 of them, so
Yeah.
I'm very happy with it.
Yep.
And my other question is, I want to do an appraisal on my business, and what type of an appraisal do I ask for? And also, should I use the appraisal company that the bank in the area uses?
Yeah. It's appraisal of a business or real estate or both?
Both.
Okay.
You said you're in hospitality, right?
I am, yeah.
So you have to be careful, first of all, and I think these people will be nodding their heads as I say this, but you should not look to order your own appraisal unless you are looking to maybe sell your business to somebody else, okay? But why I mentioned that you shouldn't look to order your own appraisal is that from a federal regulatory perspective, we're not allowed to utilize or rely on the good value conclusion that's derived in that appraisal because you ordered it.
Okay.
So you, to the latter part of your question, which is should I look to maybe engage an appraiser who is affiliated or works with the banking community, then absolutely.
He's got a good reputation.
Yeah, I would recommend that. So you have the institution that you do business with right now, approach them and say, hi, I'm looking to get either appraisal of my business or appraisal for my real estate. I'd like you to commission it and order it. I'm willing to pay. Let me know what it is, and we'll go from there.
Good point.
Yeah. That way, here's another reason why I recommend doing that, because now you have a bank-ordered, bank-approved appraisal. If you're looking to sell your business, one of the biggest negotiations you're going to have is how much is my business worth, blah, 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 or the real estate, and one of your selling points could be to the seller, well, I have an appraisal. It was independent of me. This is what they came into value. That's what I want for my property. They're going to have a tough position, a tough argument with you to try to argue that particular value conclusion, because you weren't involved in the valuation or ordering process at all.
I'll check with my bank.
Yep.
Okay.
Yep.
And it would be an as-is appraisal, or?
Question, I mean, it's really up to you. Are you looking to?
Well, either to, I'm looking to do a new development on the property, okay? So I want to possibly bring in a partner, so I
Yep.
want to know what it's worth now.
Mm-hmm. So two forms. You have an as-is appraisal, get that done so you have the value conclusion today,
Yeah.
and then have a value conclusion as completed. And the as completed piece would probably be the selling point of what you're going to be pursuing your partner with, and say, geez, this is, you put your money in, this is what half of this or a portion of this is what you can have in the as completed piece. And it's all one self-contained appraisal. It's not two appraisals where you get an as is and an as complete. It's all within the same document, same report, I guess.
And how do I know what's a reasonable figure for an appraiser to charge for an appraisal?
You said you have a hospitality business, correct? So it depends on if it's a hotel. I mean, if it's a hotel, they're gonna, a lot of times the banking institutions, credit unions are gonna get somebody that is specific to the hospitality industry, the hotel industry, and they're gonna cost a little bit more. Okay, but they're gonna give you value not just for the real estate and the furniture and fixtures, they're gonna give you credit for the going concern of the business as well. So depending on your type of business, you may want to have a going concern value, and that's really just kind of the goodwill, the customer list, that type of stuff. And again, it also depends on the appraiser. You could have 3 different appraisers doing the same appraisal, and one's going to charge you $2,500, the other one could charge you $5,500. I mean, it really does vary that much.
They're all over the place.
They really are. Yeah.
So to capture some of the other, because a bunch of you raised your hands that you're thinking about going into lending right now. What questions do you have? Anybody?
If I think about like the immediate needs for my business, I make cookware, an accessory that goes with stock pots and pasta pots. I immediately need. I'm looking for like $15,000. Why would I? I guess one of the things I'm looking into is a Kickstarter or some other type of crowdfunding. Why would I guess how do you guys compete with those new sources of funding? What's the advantages of working with a bank, getting a loan, versus crowdfunding? I imagine that affects your business for startups.
I really don't know.
Well, I can tell you that we had a customer that's been in business for quite a while, and they did a Kickstarter campaign to help with a down payment to purchase the real estate. It was semi-successful. They got some money. The problems with Kickstarter and crowdfunding is that it's not immediate. So if you need $15,000 immediately, your best bet is to start your Kickstarter campaign, go to a bank or credit union, go to one of us, and then when you start getting that money in from your Kickstarter campaign, you can always pay down whatever the loan you got. But again, it takes time, and you have to stay on top of that campaign. So, I mean, it's another form of funding, but we haven't seen.
So one thing I'd be careful of too is that,
exactly.
and I could be wrong on this, is that those crowdfunding pieces are income, right? And so there's a taxation component to it.
Right.
So the big thing you want to make sure of is that if you're going to receive the money, make sure that you're paying the taxes on it. Because the next thing you know, the IRS or the state of Vermont knocks at your door and they're not going to be quite happy.
Yeah, make sure you don't promise too much.
No.
Yeah.
We have done, we like Kickstarter campaigns, we like crowdfunding, we like it, because what it shows is that there's a demand for your product and people believe in you, and you have a market. So I think it's a good way to leverage a bank loan. If you show that people believe in you and you have a product on the market and it's ready, willing, able, and I mean, it's just a good way to leverage loan funds.
I mean, and that's huge for me too. You know, being a recent college graduate, I don't have much to offer in terms of collateral. You can take my college debt if you want that. that's not
so scary. I know.
You know, the good thing though, with the fact that the bank loan, I mean, granted it's going to have, or credit union loan or whatever, the conventional financing source is the development of credit history.
Yes.
And if you're coming out of college with, you know, some bank, your own personal student loan debt, and you're looking to start up a business, the credit history is going to be huge for your business. So maybe a mix of the crowdfunding Vermont Community Loan Fund with a traditional source of financing, you blend it all together, and you could have literally the best of all the worlds that you need, especially if your business grows, because you won't be able to crowdfund likely if your business grows and grows and grows. You're going to need something more conventional, more traditional.
15 grand is a
Yeah,
lot.
I've worked with a client who has
Can you
gone
speak up,
online funding from a source called, yeah, one of my clients has gone online to attract money from a place called Street Shares. And in Street Shares, she makes a loan application with a business plan vetted by the monitors of that site. And then they put the loan out for bid. And the loan will specify the amount, what the purpose is, information on the credit history and the business plan and so forth and so on. And then individual investors, who I might add are all qualified investors, bid to say, I will take this much of the loan at 10% or this much of the loan at 25%. And the experience I've seen is that most people are paying between 12 and 15% for their loans. So it would be a much more expensive way than going with a conventional or with some of the in-state resources.
And do they own a piece of the company too, correct?
It's a loan. It's not a equity. It's a
It is truly a loan.
Yeah.
Okay. They don't take an equity position in the company at all?
No, they don't. What they do is, as an investor, you invest money with Street Shares, and they act as the agent to invest it on your account. So it's actually a loan which is repaid with principal and interest, generally over 1 to 3 year terms.
We can classify that as a
But it's a higher interest rate, right?
Oh, yes. much
Yeah,
higher.
and I think it's just the investors trying to.
You can look at that up, streetshares.com.
Yes, we've got a pretty great, we have a great relationship with our bank, and we're looking at an increase in our line of credit. Right now, most of it is guaranteed by SBA. We're looking to increase it by about a third in order to cover worst case scenarios. We're running into a whole bunch of extra SBA fees based on the amount that we want to raise it to, the 3%, I think. The question is, one is I heard the question from Ralph before was that most of you guys won't count receivables in terms of using that in order to guarantee any sort of an increase in line of credit. If we're happy with a bank that we're working with right now, we want to increase that line of credit. We're already working with the SBA. Is it worth shopping around to other banks?
Yes, it's always worth shopping everything out.
Okay.
I think, look at the terms, look at the rates, look at the, everything. And just like you would a car, just like you would, any substantial purchase, it's just, there's a lot of products out there that you might not be aware of. Maybe it's restructuring the whole loan and then reducing your payment and stretching it out. It depends what your business is. It's all different. So I think talk to your lender, but also talk to another couple of people just to see what else is out there.
And just to add a little bit to that, sorry, David, but you should, don't hesitate to tell your existing banker, assuming you have some type of loan officer, that you're looking to get a second or third opinion on the financing that's been offered. You'll be surprised how you'll hear the terms, oh, we're going to sharpen our pencil, let me get back in touch with you. They want your business.
Well,
they
that's
don't
what
want to lose
happened last time, and we got all the money we asked for.
Yeah, yeah.
So we wasted merchants' time just by getting, some of the paperwork filled out.
Yeah.
Which I felt bad about, but now, it's one of those issues
Well,
where it just, they're saying, no, we got to go through the SBA on the additional money, and it seems like we're healthy enough of a business at this point that we feel like the bank should just trust us.
From the merchant side, I've been a sounding board for, in terms of terms and things, where people have come to me and said, geez, I'm with KeyBank or I'm with Citizens or whatever, and I'm being treated really, really well, but I really want to get that second opinion in. It's the first of the year, I'm doing a financial checkup on my business and myself. Can you take a look at these things? And 9 times out of 10, it may take half an hour to really understand the situation. And people tell you the terms, the interest rate, and how you're being handled. And a lot of lenders will look at you and say, you're getting treated fairly. Stay with them. We'd love to have your business, but stay with them. It sounds like they're doing a great job for you. And that's a wonderful validation for where you are as a business owner. Walking away thinking, okay, great. I had an unbiased opinion there, and onward I go.
Great, thanks.
I just wanted to clarify one thing though. Did you say that they're not giving you credit for your accounts receivable?
So we're in the service industry, education industry, and so all of our, it's all people services, and so we get contracts throughout the year, and so we get paid twice a year.
Yeah.
And so money comes in twice a year for us. And so they're taking it into account to some extent, but because we don't have any collateral, we're lease everything. They're not, I'm out collateralized right now. I think I've got a second mortgage on every one of my properties at the moment. So we've gotten to that point where they're saying, there's no more collateral, so we're not going to go back up, so we have to go to the SBA.
Okay.
But the cash infusion, we have a 3-year history of the money coming in pretty consistently, and would like to avoid paying lots of money in order to get money.
Mm-hmm. Yeah, from being a former banker and also working for Merchants Bank and a few other banks, that unbiased opinion is that if I was still a commercial lender at a bank or a credit union, I would probably suggest the same thing because there's no collateral. It's great that you have a track record, but what if that funding dries up?
Sure.
So I can understand where the bank's coming from, but again, still shop and talk to people because this is just the 10 seconds or I'm just looking at it from above, so I don't have all the information, but definitely talk to other people.
So unfortunately, we have a hard stop. We can take one last quick question. Somebody?
So years ago, I got the ARP loan. Is there anything like that these days? Any kind of zero interest rate? Really?
Unfortunately, not right now. The only thing that we have right now is the loan is under $150,000. We're waiving the fees, but you would still be paying, typical interest rate that you would with the bank or the credit union.
Yeah, the ARP loan's awesome.
Yeah.
What's an ARP loan?
So we have, each of these organizations, for the most part, has put something out there. So if you have more questions, they have some contact information, their website, some materials out there. So I encourage you to pick them up on that table back there.